Thank you very much, David. You don't need to go through the pres now. So this slide effectively just summarises what David was just saying. But effectively, Danakali, we've got Kaluli, which we're developing in Eritrea, East Africa. It's a unique project with exceptional economics, and we'll go into some detail on our front-end engineering design study. Very high level of accuracy and ready, shovel ready. Fully permitted, as David pointed out. It's key to understand sulphate of potash. So this is a premium potash type and a specialty fertiliser. It's a 7 to 8 million tonne per annum market, and we will be a key player in that market with almost 1 million tonnes per annum once we come online. It's undersupplied with growing demand, and there is a two-step part in the industry whereby there's primary production, which is low cost and environmentally friendly, and then there's secondary production, which makes up more than half of production, and that's extremely high cost and extremely unenvironmentally friendly. So plenty of room for us to insert our tonnes into the market. We are primed for project execution. We've got a world-class board and executive team. Unfortunately, the CEO couldn't be here today. He's actually in London further perpetuating our debt process, final documentation with two development finance institutions, so he sends his apologies. We have a project director stationed in country. The binding take or pay off-take agreement with Eurochem completely underwrites our cash flows and has allowed our achievement of the debt. And there is the debt, $200 million credit approved, and $42 million for a guarantee for the power plant that will be built as well. Just to drill down on Niels somewhat. So Niels started with us in August last year, came on as the Chief Commercial Officer, and has managed our relationship with Eurochem and other off-takers in the industry. He became CEO earlier this year. He's got a rich background, Vice President of Freight and Vice President of Potash at BHP, so perfect for what we've got ahead of us. Great development credentials and also has a lot of experience on the corporate front. Just to point out Tony Harrington, our Project Director as well. He actually was the project manager for Base Resources' Kwale Mineral Sands project, so one that's well known to the Bell Potter folk. And he did a great job there, actually came in as a Mr. Fix-It, got it on time and on budget from where it was, and he's looking to do the same in Eritrea. Just a corporate snapshot, so you can see a good history of value creation from 20 cents in early 2015 up to trading between 65 and 80 cents over the last couple of years. Clearly we are in that stage pre-funding where we're just trying to find that level, but I think rest assured that when we do get to the point of being able to finalise our project funding, that the re-rating potential for Danakali is quite significant. Clearly that will lead to a de-risking in investors' eyes. Important to point out our key shareholders, so Well Efficient is a Chinese private equity, 13.2%, and we also have JP Morgan Asset Management out of London with 7.6%. We also have strong board and senior management ownership with over 5%. Just an overview of Kaluli. So you can see on the right there, that's a map of Eritrea and it borders Ethiopia. That orange oval looking shape is called the Danakali Depression. This is a very recently evaporated inland sea. It's actually below sea level, about 100, 150 metres below sea level. And what it left was these very well-defined salts from surface, effectively, about 16 metres underground, and we're at the top of that resource. It continues into Ethiopia, and there are some projects on the other side, but they're down dip and hundreds of metres below surface, so we're in the right spot. It's also the right spot for logistics. We're only 87 kilometres away from the coast and 230 k's away from Massawa port, which is a well-established port in Eritrea. I mentioned we'll be looking to produce 944,000 tonnes per annum. We'll do this in a modular approach to keep the capital palatable at this point, so 472,000 tonnes per annum, and then we'll double that. And the ownership of Kaluli is 50% Danakali and 50% the Eritrean National Mining Corporation, which is effectively a sovereign wealth mining entity. In terms of the operational attributes that I haven't covered already, solid salts is very important, and David did mention that the majority of our contemporaries are brines. That comes with complex chemistry and unsteady flow rates. whereas we are literally just opening up a seam and selecting the salts we need to put into our processing circuit. It's simple, low-cost open cut mining. It's got a strip ratio of about 2 times, so comparable to a really good coal project or the like, and just conventional methods for that as well. The processing is fantastic as well, simple, energy efficient, commercially proven. There's 2 of our contemporaries already producing and using the same processing type, so we're not kind of breaking any barriers down to produce our product. It is a unique and favourable combination of potassium-bearing salts. We're focusing on sulphate of potash because it's the highest value product, but there is the opportunity to open up to more products down the line. We've gone through the logistics, which are world leading. Credit approval was a really important milestone for us, and this only occurred a month and a half ago. So AFC and our Frexim Bank, they're development finance institutions, billions of dollars under management across Africa and put to work in debt through to equity in infrastructure projects through to mining projects. This will be their first foray into Eritrea, which is a fantastic win for the country, but also shows that 2 established development finance institutions have done significant due diligence on the country and have clearly got comfortable. We've got a great relationship with them. As I mentioned, a CEO and CFO are in London talking to them right now about finalising documentation, and $200 million is a significant portion of our development capital. Just to take you through the industry, I did talk to you about this 2-step in the industry. So you see on the right, they're largely secondary producers. It's called the Mannheim process. Sulfuric acid and muriate of potash, which is the bulk potash type, which the likes of BHP and the Russian majors are looking to produce. And what you need to do is put them together, a lot of heat, and then convert it into sulfate of potash and have a byproduct of hydrochloric acid. So high cost and environmentally unfriendly, and of course leads to the marginal costs being a lot higher than what our costs will be, protecting margins for us. Now, even with that dynamic, the sulfate of potash price is actually above $500 per tonne in our key market, which is Europe. So everyone in the industry is making healthy margins at the moment, and we will particularly be once we come into the market. In terms of our development contemporaries, you may have some knowledge of some ASX listed companies who have projects in WA and Northern Territory. We really do dwarf them from a scale perspective. Our production will be much higher. Our location is a lot more strategic. Key markets of Europe, Middle East, India, and Africa is an up-and-coming market. We're also have an advantage with South America and North America too. Our life of mine is pretty ridiculous at 200 years, but what that does mean is we're open cut, we could double our production and we'd still have 100 years of mine life. So we don't want to get quite into that. Let's just bite off the first module first, but in terms of the expansion potential for this project, it could be a 3 or 4 million tonne per annum project down the line. In terms of the metrics, and a lot of charts here, but I'll just walk you through them quickly. Our capital intensity is almost half of the majority of our development contemporaries. Our NPV and IRR as a result, and as a result of our operating costs, are leading in the industry. The 30% IRR is particularly attractive relative to our peers, and you can see our next best peer, which is Salt Lake. They're only at scoping study level, so just not the same level of definition in their study accuracy. And then our market capitalisation is comparable to a couple of our peers. So clearly, unlocking of the potential of Kaluli, and there is significant potential for value uplift for the company. Now to take you to listed SOP producers. So these are big major fertiliser and chemicals companies. Sulphate of potash makes up a part of their product suite. These are all in the multi-billions of dollars. SQM will probably be familiar to a lot because they are quite big in the lithium space, but K+S, Compass and Descendolo are all big fertiliser companies in their own right. Clearly they dwarf us currently. Our production will actually be bigger than any of theirs from a sulphate of potash perspective, and of course they do have other products, but as you can see in the table below, Kaluli has the potential to produce sulphate of potash, magnesia and muriate of potash, 2 other potash types. Rock salt, which is used in de-icing in cold countries. The industrial and other consumable salts we have the potential to develop. magnesium products, gypsum, which is building materials and also a source of calcium, we have the potential to do, and other specialty fertilisers as well. Effectively, sulphate of potash is a specialty fertiliser. So we really have the chance to build a big chemicals company just on the back of Kaluli, and start to be seen in the echelon of the key producers. Just an overview on Eritrea. So stable government and one of the fastest growing economies globally. They do have a growing track record in the mining space. So there's been 3 Australian and Canadian companies that have got to the point of either development or production in Eritrea, and they've all been taken over at healthy valuations by Chinese companies who have a key strategic interest in the country. The most notable is Nevsun, a large Canadian company that got taken out by $1.4 billion by Zijin Mining last year, and Bisha was a significant part of that valuation. They have supportive mining laws which haven't changed in as long as anyone's been operating over there, accelerated depreciation and a 10-year carrying forward of losses. There is also a high-profile investment in Nevsun and, of course, Danakali. You've got likes of Capital Group, Fidelity, BlackRock, Vanguard and M&G who have all got comfortable with the country. In terms of developments in Eritrea, so it's actually had a lot of fantastic developments in just the last year. They have had some trouble with Ethiopia in the past. Eritrea was previously annexed to Ethiopia, but after a long piece of frosty relations, a long period of frosty relations, they have finally signed a peace agreement, and that has led to a rapid diplomatic progression, not just for Eritrea and Ethiopia, but the whole of the Horn of Africa. And there's actually a really good perpetuation of foreign interest in the Horn of Africa, particularly Eritrea now, culminating in the EU and announcing an investment into roads, which has taken place. Italy is looking into an Eritrea-Ethiopia railway, and we actually had the UN Development Programme do a report on Kaluli and said that it could be an archetype for sustainable projects in Africa. So there's a lot of positives with the region at the moment, and increasing our ability to do business there. Our experience has been very, very good in Eritrea. I'm actually off there next week, and that'll be, I've been there quite regularly over the last couple of years. Tony, our project director, is living there currently, and he has been able to witness this rapprochement with Ethiopia and the positives that it has brought to the country, and how that will continue to perpetuate. We've had Bell Potter and some of the other brokers that cover us, and David hasn't been there yet, but I think it was Duncan before him, who have been to Eritrea and reported very favourably on being positively surprised with the conditions over there. So we're very happy to be in Eritrea and with this asset. Just to drill down on sulphate of potash for what we haven't already covered. Clearly, it's a high price and a high margin given our operating costs of only $240 per tonne. It's for high value chloride sensitive crops, so your berries, your other fruits, citrus, tea, coffee, nuts. They're the types of things that sulphate of potash is used on. So the burgeoning middle class that you're seeing worldwide is actually a huge dynamic for sulphate of potash, and will lead to increased usage, dramatically increased usage we expect over the next 10 to 15 years. Here is kind of the global thematic playing out. So I mean, we all know the population is rising, but that also means the arable land per person is decreasing significantly. We also are under extreme water stress, and we currently have an under-application of SOP in developing countries. So all of these things are leading to a really intense demand force for sulphate of potash, but no new demand has come on in the last 4 or 5 years. So there really is an opening for us at this point. In terms of the pricing dynamics, there's 3 key SOP prices. Up the top there is the US price out of Florida. The middle is the Northwest Europe SOP, which is the standard, and then we've got the green, which is Chinese, and then down the bottom you've got the muriate of potash price. The grey bars show the premium that sulphate of potash has maintained over muriate of potash. Muriate of potash itself has some good dynamics at the moment, so we're seeing a lot of positivity in the sector. In terms of our key upcoming catalysts, so with the debt in place, it's quite clear that we need to complete the project funding, so equity may make up a part of that. We're currently looking at strategic and institutional sources, of course. Our we'll finalise the senior debt documentation, and that should occur quite promptly, and then we'll satisfy conditions precedent for drawdown. Project execution will then occur, and really it's quite a quick 2-year build, very straightforward. The open cut, the processing have all been done before, and we've got a project director who's got over 30 years experience. So you'd expect significant milestones as once we get the first equity dollars in the door and commence project execution. And then it's really about building on the Module 1 of SOP production and making this a truly globally significant project. So just to reiterate, and probably a couple of things we didn't focus on as much, but the binding offtake agreement for up to 100% of Module 1 SOP production, so it is clearly underwriting our cash flows, and that's from Eurochem, who are a major global fertiliser producer, $1.5 billion of EBITDA last year. We got the debt, we've got the massive reserve, exceptional economics, we got the ability to expand and diversify, and we've also got the potential for a port close by, which will open that up for us and reduce our operating costs. And Eritrea is a great place to do business at the moment, so that really rounds it up.